The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. On Money Friday, this is Your Money, Your Call.
Welcome to Your Money, Your Call, the Friday edition. I'm Mark Todd. It's the Bond Show, but we have all sorts of people on this show. I'm joined tonight by Phil Carden from Supervised Investments and Rudy Philippek Van Dyke from FN Arena. They're here to answer any of your questions. Feel free to call us 1300 30 34 35 and the email is yourmoney@skynews.com.au. Rudy, you're an old hand, so I'll start with Phil.
Oh, yeah.
You've been on before, but tell us about, for the viewers that are just watching for the first time, Supervised Investments, what are they? What do you look at? What's your remit? How do you think about the world?
Oh, look, we've got two funds, an equity fund, which is really a conservative opportunist type structure where we try and identify good value in the equity markets. That's up very well this year. Mm-hmm. And we run a fixed interest debt markets fund. Yep. The concept of that is to deliver good consistent incomes and some capital growth, but in a conservative manner. Right?
Would you suggest that your clients buy a bit of both? Is that what you're seeing? Like the trend is, I've got $100, I'll give you one for the equity, one for the fixed income. Do they do that?
Yes, some of them do. Some of our bigger clients would do that, but a lot of the customers that come through financial planners and are introduced to us that way, they'll go into one of the two funds.
Yeah.
Yes.
Whatever the goal is.
Yep.
Mate, how's business with you?
It's chugging along. I'm in the corner of the market where there's just essentially no growth. So if you go stable,
what does that mean? Does that mean you're in the entire equity market because it doesn't grow, or is it because you're in a small sliver? Because his equity performance is going really well. So
he's in a different corner. I'm in the corner where the newsletters and there's no growth there. I mean that's pretty much a fact. So.
Oh, so you've got enough. You've got a certain amount of people that are following your newsletter, and then the rest of the people are saying, "Can I have it for free?" And you're going, "No." And then
there are people who getting it for free, but not the whole thing, of course, because we always had this dual model. But what you will find, obviously, it swings and there are people disappearing and new people coming along, but that sector hasn't been growing for a few years now. So all those newsletters, basically, they're very happy they have an established database of subscribers and keeping that database. And obviously, there's the ones who don't have that are disappearing or have disappeared or are merging.
People want the information, but they don't necessarily want the advice, so they're trying to work out how to pay for the information.
A big change has been that in the big bull market, people had 3, 4, 5 subscriptions to services. Yeah. Nowadays, they hardly have one. Yeah. So that market has shrunk significantly, and you also have a lot of people who find it now more difficult to manage their own money.
Yep.
And ultimately, the wife keeps nagging every weekend. Why aren't you playing golf?
Nagging. She's just offering some advice.
Why aren't you playing golf? Huh?
And Sue, I'm not picking on my wife. I've got I'm
exactly. You're not part of that yet.
I'm not. My wife's fantastic.
But so a lot of people, and I mean, in all fairness, they manage their own money, and for a while that seemed like a very easy thing to do.
Yeah.
You owned the banks, Telstra, and a few other large caps, and you were.
If you held on, it's probably still all right.
And you were outperforming the index like there's no tomorrow. Yeah? But now times have changed, and now people go like, "What's your portfolio doing?" And it's actually not that good, not that great. And so a lot of those people, they, after a while, simply decide, you know what? Why am I not giving it to someone like Phil?
So hang on, let's go to Phil.
And I can play golf and go to Canada on a cruise, and there's a lot of heartaches I don't have.
So are you seeing the disgruntled people that he's talking about coming into your fund? Because you're a seasoned professional.
Well, we're certainly seeing the same effect in the debt markets, where all of the known credits, US government, Australian government, the easy investments like the blue chips, well, in some cases, you give them, $1 million, and 10 years later they give you back, $880,000 if you're living in Japan. So it's actually a lot harder. You can earn 9-10%, but you've got to be able to work out the good from the bad.
Yeah.
Chalk from the clay, so to speak. So yes, it's quite a bit like that, I think. Yeah.
Well, I understand as well from the fund management industry is that they are moving away from the usual benchmark. Like, for instance, they are moving away in Australia from the ASX 2 or 300. Right?
Who are moving
Fund
away?
managers.
Oh yeah, for sure. I mean, where do you, with your guys in the equities, where do they play? What space?
In specific stocks. You know, I can name them, but I wouldn't want to be recommending things. But they've done very well in identifying, just looking at value, some very, very small stocks that, you know, 5 years ago were trading at, say, 50 cents and now trading at $10. I mean, it's a long-term value-finding exercise, and also some trading. They bought some BHP, you know, a month or so ago, at 15, I think. But, you know, so there's some short-term stuff in there, but it's mainly long-term, looking for value and having patience.
I have a theme that I'm running around. Tell me if I've got this right. So my theme is this.
You're wrong. Oh, it's too early. Sorry.
The small cap space that we're at 50 cents and the like, which is the domain of organisations like yourself, is tone deaf to most of the viewers that would ring in. So most of the retail investors are not listening to small cap anymore. So it's the domain of the fund managers. Now what they're doing is they're extracting, the fund manager is extracting quite a high price for the equity. You want to do an equity raise, I'm at this price, so I'm chasing quite a high price. What I think is now happening, next phase of that, post-GFC, is that people are coming to the banks and saying, can I just issue debt rather than do the equity? And so NextDC, Capital Health, Pete are saying, rather than go to the equity market, the way I can win some equity support is by issuing some debt, showing you some assets that you can secure it against. Not secure it against, but you know, you can in the event I don't perform, you can grab some assets. And I think that's the next phase. And clients are saying, I'm more confident around NextDC because I can see how they paid off their debts. That's now $3.10. It was $1.70 when they brought it out. When they brought out the second bond, they had a failed equity raising. They couldn't raise equity. And we said, we'll do the debt again. And as soon as we did the debt, they got the equity. So my theory is the debt market is going to go into the small cap space to give them some comfort to get some investor, you know, engagement. So what do you think of my theory?
Well, I think you're certainly going to get to know the company better when you're looking at their ability to repay debt. If you're focusing on, you know, their cash flows and can they repay that debt,
Yep.
well, and at the same time you may discover some equity opportunities and you can make a comparative judgment in that
Pay
case.
back their debt, you think, okay, it might be the story about their business might be a little bit better, so I might buy their equity as well.
Well, yeah, they might be paying 7-8% on their debt, and then you look at their equity, which might be yielding
9,
5,
10, 11.
or with capital gains.
Yeah.
Then you go, well, you know, you look at the risk reward.
Yeah.
Yeah, I think that's a logical progression.
I think it's a sign of the times that investors don't like business models now that are not funded.
Yeah, I agree.
And so, like for example, we have NextDC is one, but we also have a company like called Zero, for example.
Yep.
The one thing that investors now like about the fact is that they are now on a path of restraining the cash outflows.
Yeah.
So that means that they won't have to come back for another capital raising.
That's right. People just got to put more cash in that
exactly.
business.
And if you're not funded now, then you will get derated a lot because people go like, we don't want that. Right? We really want you to get by with the cash you have, and preferably generate a lot of cash. So you might pay out a few dividends extra.
So you have NextDC in your portfolio, do you?
I do.
Yeah, right.
I do.
Okay.
It's my best performing stock for the year.
Yeah,
It's up 30%.
Yeah, it's a really interesting stock. I think of the 1 3/4 move in cash rates. You know, has that driven behaviour in a way that has gone to the next level? So in other words, have people reacted with, oh, whatever, it's 1 3/4, or have people said enough's enough, like they did in Japan when they went minus 10 basis points for. It was for excess cash, so it's wouldn't even really affect them. But the reaction from the savers was quite strong. Do you think the investor base have reacted? And I'll start with you, Rudy, to 1 3/4 saying, okay, that's enough. That's a straw that breaks the camel's back.
No, I don't think so. And I'm obviously part of the stuff I do is I read a lot of commentators and economists, and it's very clear now that there's a growing group of commentators and economists in Australia now that are talking about 1.25, 1% for the RBA. So I mean, there's no pushback there. I mean, they're all seeing the public discussion happening with, I mean, ex-governors moving in and etc. And Sol Aslake making a big thing about it. But they're pretty much convinced that we are now where the Fed was a few years ago, and we are moving towards 1%. I think that part of the strong buying support we're seeing in the share market is because there's now an idea that that's happening, and people just want to be in this market.
I think that's right. What do you think?
Well, I think I'll just talk about the debt markets.
Yeah.
I think it just forces people to look to other markets which they may not even have considered, such as corporate debt markets where you can get good yields.
Yeah.
It's a different game. You've got to know what you're doing and you've got to be able to analyse. As you know, next DC example is a good example. But yeah, I mean, what's the point of having your cash sitting there at 1.5%? You can do a little bit more work, and it's time to start, I think, an education process so that people can understand and get some confidence in the credibility of some of our companies.
I think so. I mean, Chris Joy came out and wrote that he thought it was madness. I don't know how he described the RBA, but he didn't hold back, and he had a real crack at it. And I feel that there's a sense that cash is going in a place that people haven't seen, will not see, and it's very hard to work out what to do. Does that make us risk on or risk off? What do you think?
Well,
do you think they should be more risk on?
Well,
this is where it's going. Grab it now because it's going hot.
Well, what it has created, and this is my observation from the years past, it has created a very schizophrenic market where the risk of assets in the share market are very much wanted, and at the same time you also get the growth stocks. So you get a market which is basically having both sides. Like, for example, we were talking about yield. The traditional yield stocks that are high quality and have growth, they become increasingly less yield stocks. Yeah, they're now generating, let's say, 3.5% in yield. If the cash rate goes to, let's say, 1%, they'll be paying 3% or less than 3. Yeah, so the whole yield stock concept is then changing in the share market. The high quality stocks, by definition, then become less yield stock, and my observation has been always that a stock that now offers you 7 or 8% in the market, that you really have to question, like, why is that one at that high percentage while the other guys, the good guys, are now not even offering you 4% anymore?
So tell me what your thoughts are on the banks and Telstra and the like. You know, those yields are huge.
Well, yes, and you see that effect kicking in. I mean, this was, if anything else, this was the ideal reporting season to disappoint a little bit on your growth figures, because it doesn't really matter. Yeah? The RBA overshadows everything else. I mean, CBA is offering 5.5, ANZ is offering, I think, 7, and in between are the other two and the regionals.
Is that before franking?
Yes.
Yeah, right. Look, we're going to go to a quick break because we have a chart that we'll talk about, and I want to find out if you're risk on or risk off. So we'll go to our very first break for the night, and we'll talk to you soon after a word from some sponsors.
When you have a dream to start your own business, you need more than just a good idea and a can-do attitude. You need a great education to set the foundation and help you take your idea to the world. You need great teachers and mentors to help you be the best you can be. It takes lots of hard work and many skills. And one name helped me make my name, APM at Torrens University, Australia.
The federal election has been announced. All Australian citizens aged 18 years or over must be enrolled to vote now. If you've recently changed your name or address, turned 18, or become an Australian citizen, make sure you're enrolled. Your vote will help shape Australia. Enrol or update your details at aec.gov.au or pick up an enrolment form at any post office and return it to the AEC before 8 p.m. Monday, 23rd May.
We need to bring back the Australian Building and Construction Commission to clean up illegal union practices in our building industry and lower the cost of construction. We're paying up to 30% more than we should for hospitals, schools and roads. Even housing affordability is affected because of the high cost of building apartments. I'm asking for your support to bring back the Commission for lower construction costs and more jobs.
Authorised T-Nut, Liberal Party, Canberra.
Enjoy a simpler way to get in shape with nutritious, chef-designed meals, fully prepared and delivered to your door. It's easy with Light and Easy. Call 13 15 12 or visit lightandeasy.com.au today.
8 weeks with 2 rookie leaders, anything could happen. Who will blunder? Who's gaining momentum? Resources Minister Josh Frydenberg is my guest. Ed Husick also joins us. Plus, a debate on the Bank's Royal Commission promised by Labor. Carv Ellis, Sky News Live.
Welcome back to Your Money, Your Call, the Friday edition. It's the Bonds edition. I'm Mark Todd from the NAB and I'm joined by Phil Carden from Supervised Investments and Rudy Philippek-Van Dyke from FN Arena. He thinks things are a bit tough, so FN Arena, look it up, buy a little bit of what he's saying, and Phil would like some of your money. They are here to answer any of your questions. Call us 1300 30 34 35. The email is yourmoney@skynews.com.au. So, Rudy, you've got a chart.
Yes.
So, what was your chart that you brought in?
Well, I think this immediately shows you what this is, the Australian share market.
Yep.
If you strip away the resources and you strip away the financials.
Right.
This is industrial stocks.
Okay.
And what you see is that with the exception of the run-up to the 2008 bear market and the dot-com boom, which is a big mountain up, we're at the highest level of valuations right now. And this is the problem for a lot of people who want to participate. But at the moment, I've said it this week, we are experiencing bull market dynamics in the share market. It doesn't look like it, but it is. Because people want to put money in the industrials and they find increasingly that, CSL is $110 now.
Yeah.
Transurban is offering 3.5% yield.
Woolies is.
Right? Oh, no, Woolies isn't, that's true. There's always exception. But now we have to question again the stocks that have been left behind. And if this stays the way it is, and I think for the moment there's, apart from maybe some worries from the US share market, I don't think there's locally any worries. So I think people will increasingly start looking for the laggards, Woolworths and the other ones, because you can't just keep on piling money in a PE stock that's above 25 anyway.
Okay, so Phil's one of the smarter guys in the room.
Yes.
That doesn't sound logical, does it? Like the people are chasing because they don't want to miss out. They're buying because it's cheaper than everyone else. ANZ came out with some bad numbers. Okay, we better buy because I think they'll get better numbers. And ANZ promised they'll do something, but they haven't done anything. But they promise they will. What's happening in the bond market? Is it risk on? Is it risk off? Are people getting more conservative, buying safer assets, or are they saying, listen, I'm with the equity guys. I'm just throw the brain power out and just jump in and get into it?
Well, two things, Mark. I think that chart really just says interest rates have been going lower and lower and lower and lower and lower, and it's a comparative risk argument.
Yeah.
In the bond market, all last year we saw banks adjusting their balance sheets to increase capital requirements. In the US, there was just a continual flow of corporate loans into what they call the corporate leverage loan market. Prices of corporate loans last year went from sort of on average $98 down to $91 in February this year, and since February they've now rallied up to back up to $98. That's a huge move.
Yeah.
I can say since the interest rates were dropped at the beginning of this month, I haven't never received more phone calls. I mean, people in the banking community and the brokers, they know what type of bonds I hold in the fund. I've never seen so much demand for mezzanine debt ever in my whole, fund management career.
So a couple of questions for you.
A whole lot of new buyers emerging.
Yeah, a couple of questions for you. You talked about Rudy's stuff being a relative story. Do you want to expand on that for the viewers that are watching this? Because I know what you're talking about, but in terms of what do you mean by relative story?
Well, I'm retired, for instance.
Yep.
I've got a superannuation fund with, say, $1 million in it, and I'm planning on living off that.
Yeah.
10%, that's $100,000 a year.
Days.
At 1%, that's $10,000 a year. So I look at where can I get a greater level of return and what are the risks. And I think, we look at PE ratios and we say 16's high or 18's or 25's high, but then compared to what can happen to you in a fixed rate security, for instance, when the fixed rate is 2 and it may go, the interest rates, the inflation in the US looks like it's going to go up through 2% in the next 6 months. Their bond rate's at 1.75. Who wants to make a negative 25% return? So maybe you're happy to get out of that very, very low risk security into something that's of higher risk. And we're actually seeing a money flow, a big money flow, particularly in the US into corporate debts, double B, triple B, single B secured corporate debt markets. And I think it's going to continue. So it's risk on. It's get yourself out of the low risk, low yield environment. You can't live off it. Because you can't live off it. Educate yourself so you can differentiate between the good and the bad, because no two double B bonds are the same. And a lot of them can be very bad to you, but a lot of them can also be very, very good to you. So it's a bit like you look at equities and you look at their balance sheets and you say, well, the cash flows in this company look good, its share price is here, I think that share price is going to improve. You look at the debt they issue, that may be at a yield of 9%, and you go, well, I think, in 2 years' time, that debt might be trading at 8% or 7%, and then the capital value of that loan goes up. So it's the same effect. And it's a market that offers much lower volatility and more consistency of income. So I think, I'm seeing risk going on. We're certainly looking at moving some money into those sectors.
So what are you buying? What in terms of RMBS, so mortgages, is that the sort of stuff that you're looking at the moment, or is there something else that you're looking at?
We've been, essentially, to cut along through, we've been selling Australian mezzanine RMBS, and we've been moving that money into the US corporate debt market and picking up anywhere between 2 and sort of 4%. It's a very complex process. You've got to know exactly. You can't just go and buy me a double B bond. No. You've got to look at them and analyse them and try and work them out in the same way as you would with an equity. But that's essentially what we're doing.
And are you staying unhedged?
We're hedging the currency. We don't take currency risk.
So how do you hedge the currency risk on a 5-year bond? What are you doing?
Well, we would look at the forward receivables of that bond and sell them into the market to swap them back into Aussie dollars. One way or the other, we might use options if we want to have a little bit of room to make some money out of the currency differentials, or we might just go a straightforward hedge using $8 futures on the CME in the US, or we might ring, for instance, Macquarie Bank and they'll give us a bid on the forward.
Be a crappy bid. Ring NAB.
We'll get them to give us a line.
Go for the interrupters for us Forex. No?
So Phil's essentially talking about the role that a fund manager can play that maybe the viewers here can't play is that they can trade some of the derivatives. Now, I'm not saying no one can do that. I know that there's obviously retail people can play in the FX market, they can trade in the FX market, but he's saying a combination of looking at the credit, trying to understand that credit, and then working out what he needs to hedge within that credit. Like, what is the piece within it? Is it just a currency? Is it something else? He might even take an equity position against the issuer.
See, in the share market, it's definitely risk off. Yeah? Both in Europe, as in the US, as in Australia, the assets that are believed to have the least risk are the best performers. Right? That's in the US, that's in Europe, and that's here.
So that's the banks and Telstra, is that what you mean?
Oh, the banks are not part of it. Telstra is part of it.
Oh, okay.
But for example, if you look at Transurban, this year is up 16%. Yeah? That's considered to be a very low risk, almost inflation protected asset operator. You have Goodman Group is I think is up 20% this year. Yeah? Right. So those stocks they're just killing it, and they're the traditional safe yield plays with growth in the share market. Yeah? And I know everyone's raving about BHP, but that's just a rally right now. Those stocks have performed in 3 years, and they just keep on performing.
BHP is a trader's market.
I think this is more an effect of fund managers going into the risk-on mode, as opposed to the equity market, which is more of a retail market. So when you're dealing with large parcels of marketable debt, they don't trade on a central marketplace.
We're talking $100,000.
So we're talking educated money moving in, and whether that's followed by.
But I also think what we have is, because equities are considered a higher risk place anyway. And I think I think a lot of money came in the equities market, which traditionally wouldn't be there otherwise.
Yeah.
And they've gone for the safest option in the higher risk option, if that makes sense.
I just want to try and take that. We've just got an email coming through from Matt, so I just want to try and take that email because I think that fits into the theme that we're talking about. We hear a lot about lower for longer. What if the growth boom caused by technology advances over the last century or so was something that won't be repeated for several generations? Lower investment returns for longer would have a dramatic effect on lifestyle outcomes. So it's that combination. You know, Matt sent a great thesis on the different revolutions that are taking place, but it's that idea that we are stuck in these rates for decades. And inflation, tax, you stay in cash, you are going to get hurt. I mean, it's a very slow train. You can see the lights in the distance, but you don't understand the ramifications because you can't get off the tracks. You don't know that yet. How do you answer Matt's question? What do you think it is?
Well, I think it's probably a combination of government deficits and demographic problems, and the deficits are probably caused by the demographic issue. We have ageing populations and in some countries even contracting populations. It's impossible to grow.
Yeah.
When the population contracts, your economy is going to contract.
Yeah.
Therefore the interest rates are going to be lower, your fiscal deficits are going to be higher, and you're sort of chasing your tail. I mean, if you're in Japan and we can get negative 1% interest rates and they can issue their whole debt in 100-year bonds, they won't have any debt in 100 years' time.
Absolutely.
It's a genius. It's an act of genius by the BOJ.
Yeah.
You know, they pay off their own. The people buy their bonds for $100, and in 100 years' time they get nothing back.
Yeah. It's phenomenal.
Yeah, I know, but
we create the machine. It's like it's created by man's mind. So we can. It's not like a human body that gets cancer, and you know we can actually solve the problems.
Yeah, and I do think with the story here with Matt is, unless you see some sort of revolution in some sort of technology, and it might be medical, it might be something like that, it might be some of those.
I think it's likely to be medical.
It is that idea of living longer, Matt, and it's a quality of life living longer, might create some economic activity and that might generate some growth. But it's a challenge.
I disagree on the technology front. I do believe that we are going through another revolution technology-wise. The only problem here is that this time technology eats into the existing business models.
Oh yeah.
And that's why you don't get the same effect as we had the previous times, where it's only growth and new jobs. Now it's actually costing jobs and puts a lid on growth, and it puts a lid on prices. That's why it's deflationary.
That's a very good point.
I think globally we are in this negative cycle, which ultimately also leads that businesses are going for capital light models and then have too much capital and not spending it. And one just feeds in the other one. So we're constantly getting lower inflation, lower growth, lower interest rates, lower returns, and we're not getting out of that.
We have to go to a break, but I do want to follow up on that because I think that's a really interesting thing about how corporate world is responding to shareholders to their own detriment, to the shareholders' detriment. It's what the shareholders think they want. Look, it's time for another very short break, but feel free to call us, 1300 30 34 35. Talk to us soon. Talk to you soon.
You need a website. Why not do it yourself? With Wix, you can create your own professional website. Choose a template, change your text, add one of our images, or upload your own. And just like that, you've got your own stunning website.
Uh-oh.
What's up? Does nobody use a turn signal anymore?
The federal election has been announced. All Australian citizens aged 18 years or over must be enrolled to vote now. If you've recently changed your name or address, turned 18, or become an Australian citizen, make sure you're enrolled. Your vote will help shape Australia. Enrol or update your details at aec.gov.au or pick up an enrolment form at any post office and return it to the AEC before 8 p.m. Monday, 23rd May.
At SCW Eurodrive, we're all about solutions. From geared motors to heavy industrial gears, simple frequency inverters through to sophisticated decentralised technology or servo controls. SCW can tailor a package to suit your requirements. German technology, Australian know-how, local assembly, sales and service. SCW has the drive to keep you up and running.
Being an AFL footballer, you need to trust a lot of people. You need to trust your coaches, your teammates, the club, and I trust Light and Easy for what I put in my body. Fueling your body is one of the most important things, and I know that I'm going to be able to perform because of the food that I'm eating.
Visit lightandeasy.com.au today.
The award-winning Serato is now in run-out, and in May we're offering a $1,000 gift card across the Serato range, starting with the Serato S with free auto from $19,990 drive away. Plus all Kias come with our 7-year factory warranty.
A rental property can be a rewarding investment, but even with great tenants, there'll always be life's unavoidable accidents and uncertainties. Standard building insurance may not cover damage caused by tenants or loss of rent, leaving you out of pocket. Terry Shear is Australia's leading landlord insurance specialist, with award-winning landlord insurance from $1 a day to protect your property and rental income. Call Terry Shear today or go online.
Welcome back to Your Money, Your Call, the Bonds edition. I'm Mark Todd. It is mark.todd@nab.com.au, and if you want to email me on lithium, I can give you some answers on that, but we're not going to take it on the show if that's all right. I'm joined by Phil Carden from Supervised Investments and Rudy Philippek Van Dyke from FN Arena. They are here to answer any of your calls, and we have a caller. Remember, if you want to call us, 1300 30 34 35. The email yourmoney@skynews.com.au. And we have Frank from Brisbane. Hi, Frank.
Hello, Mark. How are you?
Good. Yourself?
Very well, thanks. I've got a bit of an easier question than the one I asked you a few weeks ago about NABHA.
Oh, yeah. Oh, man, you got me in so much trouble with that one.
This one's easier, mate.
Oh, thank you.
Can you and the panel explain why banks historically and currently their PE ratio is a lot less than industrial companies' PE ratios?
Yep. Okay, did you hear that?
That's because well, in this current context, banks are ex-growth, or considered to be by the market ex-growth.
Yep.
And also banks are more leveraged than the average industrial company. So a bank will never or should never trade on a P of 20, like for example CSL does.
Yep.
Right? Because there's a lot of leverage.
I think that's right. They are more leveraged, but I think they're becoming less leveraged, which is going to increase their percentage capital and lower their returns. So it would be.
So we're going to talk about this, Frank, because this is a really good point. This is the view of the equity market, and that all makes sense. The equity market is really worried about the capital of the banks, the capital raisings. Will they do more? You know, all that sort of stuff. And they're really worried about how banks are trying to move into a conservative world of how they fund themselves and what they do with their behaviour, what they do with their business. And I'm of the view that banks already know what Rudy knows. I think the banks are well aware of what they have to do and are beating a path to do that. BT gets sold by Westpac, or a portion of BT gets sold just so it shores up its capital. What's happening in the US?
Well, I mean, essentially, certainly in the business loans, corporate loan sector, the capital requirements for those loans have gone up to a point where it's become very, very expensive to hold them on balance sheet, particularly when those loans are bundled up into a trust and sold as a bond, or what's called a collateralised loan obligation, and they've been selling them all year, culminating in February, where there was quite a rout in the market. Some of those leveraged loans for a bad loan traded down to 40 cents.
Yep.
Loans that were trading at 95 cents, some of them may have, if you had to sell, traded down to 75 cents in the dollar. So the banks were essentially given a tap on the shoulder, get this stuff off your books. Well, in the US, there's a market for it.
Yeah.
In Australia, there's been a lot of people interested in creating a market, but that hasn't happened yet.
So just to keep it to Frank's question, essentially what we're talking about is the price earning is driven by what the equity market is doing, but the debt market is saying to the banks, you need to get rid of some of these loans. You need to get either, rather than lending directly to Carden Co., he has to issue a bond. So you lent him $100, you can't do that anymore. He issues $50 in bonds. It's off the balance sheet. It's gone to some other investor, some other lender. So now you only have $50 with him. And so in terms of the risk, you've de-risked your business. The capital you need to hold is less. So that's how banks are responding to this. The US are probably a little bit more cutting edge, but the Australian banks are better capitalised and they're not driven as cutting edge. And the Australian banks are very conservative. They've already become very conservative and they're getting more and more conservative. So there's a cultural change happening in banks where bankers, can I lend you the money? They're being trained. Can I sell some bonds on behalf of your name? And so the equity market hasn't quite picked up on this yet. And that's what I think is happening. There's a challenge in terms of everyone understanding what's going on, but it's definitely happening in banking. I'm not saying go buy banks. You probably already own them, but that's definitely the trend that's taking place in that market.
But traditionally, if you look at cycles in banks, PE ratios vary between 9 and 11 in really bad times for banks.
Yeah.
And they go 13 to 15 in the good times. And you've recently seen that the banks come basically from that lower level, moving more into the higher level as the market becomes more comfortable with the de-risking and the restructuring. Because the market's now taking the view that banks like NAB and ANZ, they're doing the hard yakka, and at some stage those costs will be lower, and so there will be renewed growth.
About it, mate. Let's be honest, ANZ's talking about it, mate. We've done it. We have an email. We have another. Now that's true. We have an email from Barry who asks, I think there is a paradox in the finance and politics that I would like you and your guests to tell me I am wrong. Old people should vote for financially irresponsible government so they will receive a higher return on their capital. And young people should vote for a financially responsible government so their use of old people's capital is cheaper. Yet old and young do the opposite. What am I missing something? What are you missing, Barry? Barry, I don't think you missed too much. What do you think's happening
old
there?
People, after having lived all of their life, have learnt a lot of lessons and are probably more risk averse than young people who've got time up their sleeve and can take more risks. So that might explain the paradox. I'm not sure, but
I'm also not sure whether that's true, because I think it would make a big difference globally for global growth if governments had used the low rate environment to actually come up with some extra spending on their but they're all doing the opposite. They're all leaving it to central banks and they're not spending themselves.
Yeah, well,
again, which is quite the opposite, because you would expect them to go irresponsible in low rate environment. They went extremely conservative.
Yeah. So
get some infrastructure going.
My next
100-year negative 1% bond.
Yeah. So my next theme, other than how banks are going to fund corporate Australia, is the political one, and it's about the response to Sanders and maybe to some extent to Mr. Shorten, who was not in the game at all 6 months ago. He wasn't in the game. They were just a complete wipeout of the Labor Party. When he puts up his hand and says, I'm going to fund Gonski, I'm going to borrow the money and fund it or do whatever, older people are saying, how are you going to fund it? Younger people are saying, forget it. I want you to do the funding on Gonski. I want you to, do infrastructure. I'm ready for reform, and that comes at a cost, and I want to pay that cost. I want you to borrow that money, and I think there's something happening in this low growth world where people are saying, you know what, I've had a gutful. Let's just borrow some of this money and build this thing. Give me a second airport, and let's just have a crack at this stuff. That's what I think is happening in response to the other thing that Sanders is that since the GFC, those who had a lot of money have now got a lot more money, and there's that gap. So maybe it's part of that.
Oh, there's definitely extrapolation into society, absolutely.
What about that idea that people are looking for reform? That's why it's driven Barry's paradox. Why are you doing that?
Well, the problem is that, in theory, that's what should happen. In practice, we all know that politicians are not always very good in doing the right investments. Before you know it, politics moves in, and then they build the wrong bridge, or it's too expensive, or it never gets finished. And I mean that's me. No. Governments don't really have a good track record around the world. It should come from the corporate sector, but unfortunately, the corporate sector at the moment, in that negative spiral, is not playing ball.
What do you think? Politicians are letting us down.
I think there's never been a better time if you're a government than to borrow money and create some jobs
In theory, yes.
Apart from the fact that we've just gone through about 10 years of debt is bad, debt is terrible. We've got to get rid of all debt. It's, purge the world of debt. Well, why you can borrow at 1%. Why not go and borrow $1 trillion and replace every freeway in the United States of America? I mean, have you driven through LA lately? It's the place is falling apart. They could easily spend $1 trillion there.
Oh, America's rusting.
And there's never been a better time to do it. So apart from this whole fear of debt to GDP or debt to equity arguments, do governments really have that problem? You look into how it works.
But I don't think people know how much.
Too, isn't it? Like, because we had previously a government that had these three-word slogans, and all that was bad. But I
don't think people know how much debt we've got. I mean, I think that's the greatest problem. I have conversations with people. We've got to get rid of this debt. Well, how much debt do we have? I don't know, but it seems like we must have a lot.
Yes.
So does that mean we're thinking global growth is low for a while? So let's give the viewers some idea of where they should put their money in terms of sectors. Where is the low-hanging fruit? Is there any low-hanging fruit with cash gone to 1 3/4 here, the rest of the world's negative? Where do you put money if you are a global investor? Do you look at the US and buy into the US story? Or where do you think if you had $1 to put somewhere other than your own fund, where would you put it?
Oh, well, as I said earlier, when we're going into the corporate market.
That's the only spot. There's nothing else. You don't say, OK, if you could buy emerging market...
No, I'd buy low-density real estate in economies with growing populations. Like we've got a big immigration program in Australia. I would be getting out of high-density and going into low-density real estate in areas approximate to, transport nodes, healthcare nodes.
He wants you to buy the Pete bond because that's what they do. Where would you put money?
Well, I would hope that governments put in money in infrastructure. I mean, the world, and that includes also the investment community, is screaming for real estate or for infrastructure assets, and there's just too few around of them.
Yeah.
Right? And you would think that, where is there no congestion? I mean, everywhere is congestion. Sydney is full of congestion. And you go to Europe and there's congestion all over the place, especially in countries like Belgium and Holland, which are densely populated. So it's not like there's no. And in the US, you see all these reports about how infrastructure there is so deteriorating. Bridges are collapsing there because nobody spends time and money on maintenance.
So you brought a chart in. What did you bring the chart in? What was it on?
The chart showed you the difference in the yield curves for sovereigns, Australian sovereign debt, US sovereign debt versus the corporate markets. Okay, so you can see the AAA rated, the lower curve there around the 1% mark, up to a bit over 2%. That's the US Treasury curve, and then you have the Australian Treasury curve above that. The point here is that everyone's running around saying, well, look, I can only earn 1 or 2% of my money. If you want to go and lend money for 10 years in the corporate sector, you can probably earn 7 or 8 if you're able to put the same amount of work into those investments as you might put into researching an equity investment.
Yeah, right.
So do we have a low rate environment, or do we have a two-tiered interest rate environment?
I think
we've got a two-tiered rate environment, and we've got to become more analytical about how we look at certainly the debt markets and apply some equity theory to debt, so we can start getting some of those annuity incomes, especially if we're in retirement.
We've just got an email from Kim Jordan about the noise in the studio, and my mother tells me every week, can you stop the noise? It's the setup of the studio, so we do apologise. We'll try and talk louder, but it is one of those challenges that we don't really have an answer for, but it is a bit frustrating. So I do apologise for all that stuff. Tell me, where do you put your money? $100. He's going to put it into. He's got this fund. He's going to put it in that. But he's also saying, low density places because the demographic story. And where would you say? Look, okay, what sector looks interesting to you?
I'm the equities guy, so I still see a lot of opportunities in structural growth stories, and they're definitely available in Australia, and they're obviously younger mid-cap companies, not the bigger ones. There's growth there, and there's quite a few of them that this year yet are a little bit lagging, but are now being picked up.
Yep.
Right? There's no secrets there. It's outdoor advertising. It's the middle class in Asia. It's it's the cloud infrastructure, right?
Yeah.
NextDC, but also the developers like Aconex.
Yeah.
It's Zero, it's that type of companies.
Right.
But and those companies, by definition, will be at a higher level in share price in the years ahead because they have the wind in the sails. I mean, they can only do it wrong, but you have to come up the ladder and not stick to the top 20, go out top 50, because we're talking
That's
here.
the harder
right?
question. That's the harder challenge. You might go, if you do that, folks, you get a little bit of his stuff where you're more conservative before you take a bit of his stuff. But anyway, look, we will go to another break. It's the last of the night, and then we're going to talk a little bit about hedge funds, and we want to talk about the US. Talk to you soon.
This is my favourite place in the whole world. I'm going to sing here.
She's remarkable, isn't she? She can be a little flat. Just a tad.
Florence Foster Jenkins.
Right now, with a new NAB personal credit card, you'll enjoy 0% on purchases and 0% on balance transfers for 15 months. Apply today.
The award-winning Serato is now in run-out, and in May, we're offering a $1,000 gift card across the Serato range, starting with the Serato S, with free auto from $19,990 drive away. Plus, all Kias come with our 7-year factory warranty.
It's special time at Coles. Magnum ice cream varieties, 4 and 6 pack, just $5 each. And Smith's crinkle cut potato chips, 170 gram pack, half price. That's right, half price. Only at Coles.
I sank everything I had into starting Edible Blooms. There's nothing better than putting everything on the line because you've got to make it work. An entrepreneur is just a little bit of crazy and a lot of can do. Edible Blooms is just like a florist, but you get to eat our bouquets when they arrive.
As an online store, focusing on the customer is everything to us. We love new technology features that help us run our business.
With Telstra, we can take our Neato online store to where our customers are. So if that means they're on eBay, if they're on Facebook, our Neato store can talk to them. I still remember my first Brisbane customer. He sent a gift to his wife just because. That melted my heart and I felt I was really onto something.
Join the thousands of Australians who are saving with real insurance.
I saved $800 on my home and contents material.
$238. Go online and save up to 20% on your home and contents insurance. Or call Real on 13 19 48.
Are you ready for me to blow your minds? Look at your website, now look at mine. Back at yours. Yeah! Let's be honest, your website is older than leftover noodles and it's starting to stink. You need Wix.com.
Wix, create your stunning website today.
Why would humans leave Earth for Mars forever?
I'm allergic to the planet.
Nasonex Allergy targets 4 allergic responses. It gives more effective hay fever relief than antihistamine tablets. Enjoy Earth.
Welcome back to Your Money, Your Call. It's the Bonds edition. I'm Mark Todd from the NAB, and I'm joined by Phil Carden from Supervised Investments and Rudy Philippek van Dijk from FN Arena. They're here to answer any of your calls. Now, it's the last segment of the night, so please call us if you feel that you'd like to chat. 1300 30 34 35. The email is yourmoney@skynews.com.au. Kim, thank you for emailing. They went and turned down all the TVs. They ran around the room. It was fantastic. You've had an effect. Cause and effect.
He's lying. But people don't know, the viewers don't know that you guys had a very interesting discussion off camera.
Yeah, I was saying
volatility and risk.
I was saying that we've got to work out the difference between volatility and risk. So just because an asset's volatile doesn't mean it's risky, and just because, there's just that point of differentiation, isn't it? So do you want to walk us through that, what your theme is?
Well, I think where you start, it's really important to understand why you're investing. What do you want out of your investment? And an analogy might be when you're buying a car. If you're having a family, you'll buy a big, safe car. If you're trying to attract a new partner, you might go and buy a red sports car.
Yep.
So when you're investing, if you're looking to retire, you want income, and you don't necessarily want liquidity. So volatility and risk. If we were to look at a loan, risk would be, are they going to default?
Yep.
Are you not going to get your money back in 5 or 10 years' time? Volatility would be, if it's a traded loan, what's going to happen to the price in between? Now, if you're happy to earn, say, 7% for the next 7 years on your investments, the volatility doesn't matter if the risk is right. If you're comfortable with the risk and you've measured it and you understand it, the market will move that up and down as they do. So and that's an opportunity. But then volatility can also be an opportunity.
Yep.
If you want to be low risk and have high liquidity, sure, you're going to have 1% or 1.5% income, but then when the market gets really worried about something which is relatively quite safe, you can cash in your low volatile, low risk investment and go and buy something that's quite cheap. So it's really about who are you, what you want to do. But I think the low interest rate investment and the highly liquid investment is maybe a bit like the same risk of renting versus buying in a rising market. I mean, you can very quickly get priced out of a rising real estate market, as a lot of people have seen over the past couple of years in Sydney, for instance. In the same way, if you just want to be paranoid about losing all your money and sort of put it under your bed, well, you might just get priced out of your lifestyle, whilst at the same time, if you take more care and understand how and why you're investing, you can enjoy a good income level, but you've got to wear that market risk.
Yeah. So I think, Phil's right, and he's talking about the portfolio construction story at the time, that you can construct it. And then I think it's about how often you want to then test it. You want to say, look, okay, is it still meeting my requirements, and has anything changed with the underlying asset? What's your thoughts on all that? Because it is really important to get it right. And I own equities. I don't know about him, but you have to own equities. I'm not saying
Absolutely.
Don't own equities. He might be.
I own bonds and equities.
No, I'm not saying that.
There's got to be. That's about the portfolio construction story. I mean, that is. If you take anything out of this show, it's about sitting down with a piece of paper and saying, okay, well, where are we? Where are we in our life cycle? And it's all about that sequencing risk, and it's all about looking at a challenger ad and saying, what does that annuity pay? I want you to work that out.
See, in the share market, volatility does sometimes, from a certain angle, does give you an idea about the risk. And it works the other way around as well. It becomes a problem for a lot of people, because a lot of people, for example, they want to own Sydney Airport or Transurban, but the shares don't come down. They always feel it as a barrier. They never can buy it. And then a year further down the track, the shares are up another 30%. And they can never buy it because they're always hoping that it does at BHP or Fortescue, and it never does.
Right.
So it deters people in the share market from buying a good asset. And they don't want to pay. They don't want to overpay, which basically means they never become a shareholder, essentially.
Yeah, I agree. What are your thoughts on the annuities in the annuity space? What sort of returns should people? Now, we're not going to talk about a specific company.
Well, we're just looking at let's say we're looking at an annuity where you put up $100,000. I mean, simply what happens is they go and buy a portfolio of bonds, and they price that annuity at 1%, 2%, 3%, where they know they can buy assets. So that's just, they're just essentially borrowing money from you at 3 or 4 and lending it out at 6, depending upon what level of risk the manager of that annuity pool wants to take. I would suggest you're far better off going into if you want that kind of secure income, you're far better off going into a managed fund that suits your risk profile, that's going to invest in some kind of debt securities, maybe a little bit of some hybrid securities to add a bit of colour, performance, but really you'll get a better return, and you can slowly cash that in, because once you pay for that annuity, you're probably getting nothing back at the end.
No, and I think
that's one thing with annuities as well, because interest rates constantly go lower. Yeah. Like, how much can the annuities continue paying you?
Well, that's the risk, inherent risk. If their liability on the annuity is a longer time frame, then the assets on the other side, they're borrowing long and sort of lending short.
The annuity for life is the challenge. Yeah. What worries you at the moment? Because we've only got about a few minutes to go.
What worries me at the moment is that the Federal Reserve gets stuck into no man's land where they don't know what to do, and they're not doing anything. and it forces central banks into extreme actions elsewhere, including Australia. And ultimately, that the investment community loses confidence in the ability of central bankers to keep this in rein, and then we really get mayhem in the share markets.
In April of this year, Central Bank Governor Stevens said that rates were where they have to be. He gave a speech in December. Sorry, he gave a speech in New York, and he said, "Look, you know, we've gone as far as we have. There's only a certain amount you can go. You know, you can't keep bashing this thing." And then he came back, and a month later he lowered it again, 25 basis points. What worries you if central bank policymakers can't even hold the line for 6 weeks because things have changed in that time? Is that the sort of thing that worries you about central bank behaviour?
Well, I do agree that there's not much more they can do, but what I'm genuinely worried about is the political environment's inability to do anything about deficits. If we, for instance, look at the period after World War II, when the US had 125 debt to GDP, they simply put a tax on everybody that earned more than $200,000 a year at 92 cents in the dollar. And I mean, that didn't change that person's consumption behaviour in any way. It would be like putting a tax on someone these days who earns everything you earn over $2 million, it's 95 cents in the dollar. It pays off the debt, and that person's consumption behaviour changes in no way. I mean, they're not going to like it, no. But it changes the whole optimism of the consumer. The consumer's sitting there going, my God, this is a massive mountain of debt. The government can't afford to do anything. There's an imbalance of power in the Senate, and there's an imbalance of power in the House of Representatives. We can't get our agenda through. That really worries me, that we don't have a driver.
I just want, you know, we've got to go, but I just want the people to think about what he's talked about as political leadership, and we were going to have Ms. Clinton versus Mr. Trump. And there's going to be different types of political leadership when one of those people win. That's all we have time for tonight. I want to thank you for watching. I want to thank my guests, Phil Carden from Supervised Investments and Rudy Philippek Van Dyke from FN Arena. Reach out to them. They're on Google. I'm Mark Todd.
We need 90 minutes. We need 90 minutes.
Have a good Friday. Enjoy your weekend.
Thank you.
That was good.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.